We have double bottom last week. Measured move target is a little bit above where we are. And you can see we're right at the bull trend line. And above the 60-minute moving average. I have these two green lines. We had on the weekly chart an outside an OIO last week, and we had a small inside bar 2 weeks ago, and its low and its high are important. The market may totally reverse those prices, and I have them as green lines here. This is that low from 2 weeks ago. This is the high from 2 weeks ago. I don't have it drawn in, but 50% correction of the sell-off from here is right around where we are right now. So this is about a 50% correction from Thursday's collapse. Sometimes, let me go back to the daily chart. Over here. Sometimes when you get a huge bar like that at the start of a bear trend, a give up bar, the market goes back above the top of the give up bar, and instead of reversing up completely, it ends up having a second leg down. So this becomes a spike pullback channel. And that's what the market's doing right now. It's trying to test the top of the sell climax, the moving average. And I'm going to see if I can find an example of what I'm talking about. Yep. Okay. This. So a big bear bar, and sometimes you test all the way up near the top of the bar before you get a second or third leg down. Big give up bar almost totally reverses it. A doji bar like we had on Friday, and then a bull bar like we're trying to get today, yet it still got a second leg down, and ultimately a lot of bars later it went a lot lower. So the point I'm trying to make about this is that even if we retrace completely the sell-off from Thursday, it could still be a change in the market. It could still represent a change in the market that could lead to a sell-off for many bars later. And that's what the market's deciding right now. Is this going to be like this and like this, or is it different? And we don't know. And we'll find out. I think the upside is limited because of the weekly and monthly sell climaxes. Buy climaxes. Here's the weekly chart. We have an OIO. Okay, we have an outside bar. We have an inside bar followed by an outside bar. And this week might be another inside bar. So this week might become an IOI. With last week as big as it is, and with us back to the middle of last week, this week could easily be an inside week on the weekly chart, which, back to the weekly chart, it's just more of this type range. Here we had a big bar followed by an inside bar. All right, we're always in long simply because of the big gap, and then the bar is rallying. You can see traders are buying, hoping that it's a trend from the open bull trend. 60-minute moving average support. We're at the measured move based upon yesterday, Friday's range. And you can see on the daily chart, we're getting vacuumed up to the daily moving average, and especially Thursday's high. So what do you do here? Well, I would say 30% chance this is the low of the day. Small tail on the bottom of the bar. One tick tail on the bottom of the bar, and then a gap up and a big rally and a reversal. We went down sharply on Thursday, and now we're gapping up, and the bears who sold there are buying back shorts. I bought back a lot of my shorts, most of my shorts on Thursday near the end of the day and Friday, and I'm looking to put the shorts back on somewhere, up around Thursday's high or somewhere up in here, unless we reverse up with a really big bull trend day today. Then I'll wait. All right, so always in long, 30% chance this is the low of the day. Important second bar, is it also going to be a big bull bar closing on its high, increasing the chances that it's going to be a strong bull trend day, or is it going to be a disappointment bar, increasing the chances that we'll test down maybe to the 60-minute moving average. So this is an important bar. What are the chances of today being a big bear trend day? With one looking like that and the context the way it is, I think the chances are against a big bear trend day. We had a couple days over here. We had a bull day, tried to sell, failed, and then over here we had a bull reversal day, and we sold off all day. But that bull reversal day was after a big gap down and had a pretty good tail on top. So it was a more bearish situation than this. This we're trying to reverse up from a bear trend. And that second bar, the current bar, is important. Right now, here we are, a minute into the bar, and the market is stalling at the high of the first bar. Suppose on Friday, we had a bull bar and then a bear bar, a good looking bull bar and then a bear bar. On Thursday, we had a bull bar and then a bear bar. Well, guess what today's going to try to do? It's going to try to be a bull bar and a bear bar. But unless 2 is a pretty good looking bear bar, I think traders will not sell it. I think there's at least a 30% chance we've seen the low of the day right now. A lot of times when you get a big gap up, the market goes up 3 bars, 5 bars, sometimes 10 bars, and then it pulls back. It has to get closer to the average price. Gap up very far above the average price, had to come back to the average price. Here we get a reversal, and this early rally became the high of the day. We do not have that. We do not have this. This is the kind of thing that I'm talking about. That a lot of times you get a rally, sometimes it's 3 bars, sometimes it's an hour. But when you get a gap up and a rally, the market usually has to come back somewhere near the moving average. And here we had 8 consecutive bear bars. 1 or 2 were dojis, but it's 8 bear bars. So you think, oh my gosh, it's totally reversing and it's the high of the day. No, it's a sell vacuum test of the moving average and the low of the day, or a double bottom. Here, a little pullback to a small double bottom, and after you get 2 or 3 bull bars, you have to bet you've seen the low of the day. Here are a couple bear bars in rally. Okay, again, reversal at support, a double bottom, and a reversed up bear breakout, but then a little bull bar, and then another 2. After 2, 3, 4 bull bars, you got to be thinking, oh, this is one of those double bottoms pulling back to the moving average, and we're forming the low of the day. Okay, do not have that bear bar. Okay. Bull bar, small pullback bull trend, small pullback bull trend, trend from the open bull trend. This is common where you gap up and rally for an hour and then spend the rest of the day going sideways. So right now the math is good for the bulls. It's still possible for the bears to get a bear trend day, but at this point I would say 25% chance the bears will have a bear trend day. At a minimum, the bulls want the absence of a bear body on 2. Buyers below 2, and probably buyers below 1 if we get there. On a day like this, the odds are the day is going to be a bull trend day or a trading range day. Yes, the bodies are shrinking, so we might get an early pullback, possibly all the way down to the low of the day. We're at the daily moving average. Here's the 60-minute chart, but that's the daily moving average. Here's the daily chart. We're right at the average price. But the odds are the best the bears can hope to get is a trading range. And it'll either be a bull trend day, which is the most likely, a bull trend, trading range, or bear trend, or it'll be a trading range day. Can we get a parabolic wedge opening rally? It's possible, but more likely the best the bears will get is a sell-off down to the average price. Every bar that gets added here replaces one of these bars from way down here. So we're replacing, of the past 20 bars, we're replacing the really low ones with really high ones, and that's making the average go way up really fast. Okay, so a lot of the bulls who bought one, it looks like they're scalping for a couple of points, but still always in long. Let's say 2 is a pretty good looking bear bar. Can you sell it, betting that it'll be the start of a test down to the moving average and low of the day? I would not. Even if it's a strong bear bar, I could see getting out of longs, but I would not sell. So I think the choices are swinging along or waiting to see what we get over the next hour. Do we test down to the low of 1? Do we get a deep pullback? We're not getting this. This is a sell-off immediately on the open. Today is more, probably the best the bears will get is something like that, a sell-off and then a double bottom. Maybe that. Still buy the close trend from the open despite the shrinking bodies. The next magnet is that green line, which on the weekly chart, we had that outside down week last week. That green line is the low of the week before. So it's the breakout point. That week was a buy signal bar. It triggered by going above the week's high, but it reversed down. It was also a sell signal bar, and it triggered by going below the low of the week. And now we're going back up to test the low of 2 weeks ago, the sell signal. What do you do if you're a buy the close bull? Well, odds are there are buyers below 4, but the odds also are we're going to get to the moving average either by going sideways or down. Can you short here below 4? No, probably buyers below 4, a trend from the open bull trend. Suppose you get 3 consecutive bear bars. Well, then you can get out of longs. Then you're starting to think we might be getting that. Okay, gap up, and then you start to get 2, 3, 4 bear bars, probably going to test the low of the day and the moving average. Shrinking bodies 3, 4, and we know that the buy the close bulls 1 scalped at least part out at 2 points, but still always in long. And right now, probably more than 30% chance, maybe 40% chance we've seen the low of the day. Every bar that gets added increases the chances that one will remain the low of the day. It might be 50% chance already. hit 5 ticks above 4. So the 1 point bull scalpers have already scalped out. Whenever you get these bull microchannels on the open and then you get a pullback, you got to be thinking that, well, maybe we'll get 2 more legs up and then a parabolic wedge top early high of the day. Pull back and then second, third leg. Breakout, second, third leg. One, two, three, 4. 1, pull back, 2, bear bar, and then 3. Tried to get a parabolic wedge, broke above it. When it finally got to the moving average, it rallied again. Tried to get a parabolic wedge, broke above it, pulled back to the moving average, rallied again. You can see in both of those resumptions, we got a reversal, late reversal. Parabolic wedge just went sideways and they got bull trend resumption. Bodies getting small, right? So we've had 3, now possibly 4 small bodies. Four, failed breakout yesterday's high. Bears trying to get a second failed breakout below 6 for a possible high of the day, but too many bull bars, so I think it's a low probability short. Will there be bears selling that? Will bears look at that and say, okay, 3 small bars and 5 bear bar, maybe tight trading range, maybe I can sell the high of the bar and make a scalp. It's important to pay attention to see if they are able to do that. Can the bears make money in a strong bull trend? If they can, then the bull trend is not as strong as it originally appeared. Sold by the close, it is, but it's less certain because the bodies are getting small. That's 4 dojis. This looks like we're going to get an attempt at a parabolic wedge top. This is the second of the 3 legs. I think pullback's too small to sell, so you're either long or waiting. I don't want too many lines on the chart. I'll get rid of that. And I'll get rid of this. Daily chart at the moving average, which is also at the sell climax high, Thursday's high, and it's also on the weekly chart at the low of 2 weeks ago. So we have several resistance things right around where we are. You can see we're at the daily moving average. Here's the 60-minute chart at the moving average, at the sell climax high. 50% pullback from the sell-off from the all-time high. I would not short below 7, even though failed breakout yesterday's high, second entry. The bears probably will need a parabolic wedge, so bulls will probably buy the second reversal down just like they bought below 4. Bitcoin, again, just rallying strongly. Weekly chart. There's more talk on the news and on news websites about Bitcoin becoming an alternative to gold as a place to park your money safely. And if institutions start to see it that way, more and more money will switch from gold and GLD, the ETF, into Bitcoin. This is a buy vacuum up to many resistance things here. Bulls trying to get a gap, 6 high, 8 low, still by the close. And even with 8, let's say it's a bear inside bar, the odds are the rally is strong enough so the bears will need a parabolic wedge. So chances are there are buyers below 8 and we'll get at least one more push up. While any reversal down can be the high of the day, this is a low probability bet. However, if the bears get 3 or 4 consecutive bear bars, the probability will start to go up. What do the bulls do if 8 closes on its low? I think it's okay to get out below, but I suspect that the bears will probably need a third push up and a parabolic wedge. 2 ticks below the 6 high, so that's good for the bears. They closed the gap and fell 2 ticks. Limit order bears who sold a point above 6 made money. Stop order bears below 8, I would not, even though second failed breakout yesterday's high. Probably going to get one more push up and then an attempt at a parabolic wedge. Bad follow through again. So this is probably not going to be a relentless strong bull trend day. Okay, gap up and tried to get a low 1, tried to get a low 2, went sideways and resumed up. The best the bears got was sideways to the moving average, and that's probably true here as well. Even if they get a reversal, probably the best they get is a bear leg and a trading range. This so far does not look like a small pullback bull trend, but it might be. The big problem I think that the bulls have is location. 50% pullback from last week's sell-off, testing the low of 2 weeks ago. Last week was an outside week, and then testing the daily moving average. So it is a buy vacuum test of resistance. But that does not mean the market has to reverse as soon as it gets to the resistance. And it probably will not. It probably will go sideways at best. So we might be doing this over the next 10 bars or so. Possible high of the day, swing short. I would wait. What happens if we get 3 decent bear bars closing on the lows? Then the bears will have 1. But even then, when the channel is as tight as this, even if the bears get 3 or 4 bear bars, the odds are the market's going to test back up to that 7 close. It's still a buy the close bull trend. 15-minute chart. Globex, 3 pushes, 1, 2, 3. Possible final flag. Day session 15-minute chart does not look like a very reliable sell. We have shrinking bodies, so the bulls are losing momentum, but I think it's still always in long. Back to the Globex 15-minute chart. Remember, the bears want to see, a huge bear reversal. If they do not get a huge bear reversal, they want to start to see a series of bear bars with decent sized bodies closing on their lows. 8 qualifies, but 9 does not. So 9 reduces the chances of this being the high of the day and increases the chances that we're probably doing this. Failed low 2, but the past 6 bars or so, we're losing momentum, and we're probably converting into a trading range. What about selling the 9 high? I would not. I think traders bought the 8 low, they bought the 9 close. And if you're buying the 9 high, I personally would not. We have buy the close bulls 7, disappointed 8, and a lot of them are going to try to sell at the 7 close. They're going to try to get out, deciding that it's no longer worth holding a buy the close bull trend. So looks like this kind of a thing. Bull bar here. Buy the close bull trend, disappointed traders. It got back to that close and the bulls sold. And I think that's more likely than not to be the case right here. Bulls trying to sell around the 7 close. Bears probably trying to sell there as well. This is a buy vacuum test of all kinds of resistance, and then the market stalling once it gets there, deciding whether it'll break out above the resistance or reverse down. The chance of a reversal down over the next 5 or 10 bars is small. Probably the best the bears get is sideways. Bulls trying to get out here, and most of them could not unless they placed their limit order a tick or 2 below the 7 close. And when you get the bulls trying to get out, they should be able to get out, so we should get over that 7 close. However, you often get a give up bar. The bulls who did not get out, they start to see bear bar, big bear bar, and they just give up. Here, this is very similar to today. Breakout and then small bars. Low 1, low 2, but trading range more likely than bear trend. And ultimately, this day became a bull trend. All right, so are we going to break strongly above 7, indicating that the bulls did not panic and they held on to their longs and other bulls bought? Or more likely, are we going to get a pullback around the 7 close because by the close bulls are disappointed? I think we're going higher, whether or not we go sideways to down first. You can see the fight at the 7 close. A lot of the bulls have limit orders to sell, but there may be some huge institutional buy orders there as well. We just don't know. Everybody knows, not everybody knows, but a lot of people know that the disappointed bulls are trying to get out, but there may be a handful of big institutions just waiting for this test, and then they go ahead and buy 1,000 contracts and create a surprise bull breakout. That's probably not going to happen, but that can happen right here. 1 tick above 7, So are bulls going to sell, or are even stronger bulls going to buy? We're so close to the target that we probably have to get there. That's the low on the weekly chart from 2 weeks ago, right there. So looks like a lot of the buy the close bulls gave up, and you had bears selling as well, right? Taking a chance that the bulls would give up. Probably the best the bears get is this. So here, buy the close bulls giving up here, and then more so here. But the best they get is, best the bears get is a tight range. This is the end of the first hour, and a good reversal. We sold off, we gapped up and rallied, so we're reversing up from a break below the bull trend line. Now that means we have a flatter bull channel. Well, the bears a micro double top, but probably not a very good stop entry sell. And will the bulls buy the 12 low? I think we're probably entering a tight trading range, and I think the bulls would like to buy lower and after more bars down. Potential for a breakout, but I think not a very high probability buy. Remember I said there may be some institutions knowing that weak bulls will exit on the test of that 7 close, and those institutions see that as an opportunity to create a breakout, forcing all those bulls to buy back their longs. I think not a great buy. We have a good first hour, and the bulls are trying to get a good second hour. At resistance and starting to get a lot of small bars, so losing momentum. So a lot of traders, I did not buy above 12. Back above the breakout point on the weekly chart, 2 weeks ago was a buy signal and a sell signal, both triggered, and now we're back above the sell signal price, which is the low of 2 weeks ago. This week probably is going to be an inside week. We opened in the middle of last week, and last week was an exceptionally big week. All right, so now we've had some kind of a 3 push pattern, 1 pullback, 2 pullback, 3, or a double top, 1 pullback, 2 pullback, 3. Trend from the open bull trend. Today looks stronger than this. But not as strong as that, and not as strong as this. We have a breakout 1, 2. And you're always going to be thinking that whenever you get any kind of a strong breakout, usually, 60% chance you'll get a measured move up of some kind, usually at a minimum, based upon the open of the first bar to the close of the final bar of the breakout. and these two bars were clearly breakout mode, and then we started getting small bars, and we're at that target as well. We're at resistance, but it's a small pullback bull trend, and today probably will remain a bull trend day. Probably the best the bears can get is a trading range day. It doesn't look climactic enough for a parabolic wedge reversal, and therefore I think the best the bears will get is a trading range. Maybe later in the day after an extended range, the bears can get a final flag reversal, but going forward, it looks like we're doing this for the next hour or two. We have trading range bars, but a reversal probably will result in a trading range and not a bear trend. I think this illustrates another important point. I'll do it right here. I've been shorting and increasing my short position over the past several weeks, and I was short many different ways. And one way was puts. I bought puts, and a lot of the puts I had expired in August, which means the end of this week. And when I get a gift like that, in general, I don't want to hold any kind of options into the final week because the time decay is so great. And when I get a gift like that, like we had on Thursday, I almost always, and there's only a week left before expiration, I almost always get out. And then I decide, do I roll it forward and buy puts in a later month, September or October, or do I wait? And I chose to wait because of this, we've had so many reversal attempts and every one failed. And therefore, even though this might be better than those, given the context, there's still a good chance that it would fail and do what it's doing today. So if the market's giving me a gift in the options market and I only have a week left, I don't have time to sit through a rally that forms a lower high and then hope for a second leg down, all before the options expire this week. So I just exit, take the profit. Still a trend from the open bull trend, no sign of a top. Downside risk small, not climactic, so probably not going to get a parabolic wedge reversal. No sign of a top, right? So you're either flat or you're buying and you're using a stop right now, probably below 10, possibly all the way down to the low of the day. Becoming stronger, so that increases the chances of a parabolic wedge top, but this is so strong that first reversal down, traders will still probably buy it. So it's still not yet a parabolic wedge top. Downside risk is small at this point. A little bit of overlap, 14.7, possible measured move up there. A lot of room to go if that's where we go. Becoming a stronger trend, small pull. Well, it's not a small pullback bull trend. It's just becoming a very strong trend from the open bull trend. I don't have any example of that. Downside when the channel is this tight. Downside when the breakout's that strong. Downside is small. Best the bears usually get is a trading range. Let's say you get a bar closing in its low. Bulls they can get out, but the downside risk is small. They can hold long, rely on a stop. If the bears get 3 consecutive decent bear bars, the bulls could get out. But even with the 3 consecutive bear bars, the odds are the best the bears get is the trading range. And for the bears, let's say you get a decent bear bar. It's a small pullback bull trend. Look how big the pullbacks are. 1 bar, right? Chances of this falling very far are small. So, and then, just look over the past 10 bars. How much money have the bears made today? If they sold 1 point above 5, they made money, and that was it. So I would not be eager to sell until the bears demonstrate that they can take control, which they have not yet. A lot of bulls will not exit here. They'll just use a wide stop, maybe below 10, and then look to scale in lower. I think it's okay to exit because it's climactic, but if you're trading always in and you exit, you have to buy again above a bull bar. Like if you exited below 8, you buy above 10. While it's possible it's the high of the day, I would get out of longs. I would wait. It's still possible it may behave like a parabolic wedge, even though it doesn't really look like one. 1 pullback, 2 pullback, and then buy climax for 3. If it does behave like a parabolic wedge, we'll probably get 5 to 10 bars in a tight range. Still will be a bull flag, still more likely to go up. But if it goes on for 20 or more bars, then you look for a reversal down. 10 or 20 bars, bear breakout, a pair of bear bars. This is similar to today, a parabolic wedge that, the spacing, the leg sizes are not symmetrical. All right, so theoretically, the always in bulls, they can either stay long or get out. If they get out, they get to buy again above a bull bar, which might be 19 or 20. Since this is credible enough on the part of the bears, a lot of the bulls will wait for a high 2 buy closer to the moving average. So I would not buy above 19. If you get out, I would wait for a couple legs sideways to down. What happens if we get a second bear bar, and let's say the bear bar is bigger than the first? Well, that would be consistent with what I'm saying. The bears are doing enough now to make the bulls hesitate. And what about the bears? Can they sell the close of 19, taking a chance that it's like that day, the all-time high day here? Rally does not, it's a parabolic wedge, 1, 2, 3 nested within a bigger wedge. And we got a pair of bear bars and just sold off from the all-time high. We might get this. This is what the bears want. I think the overall appearance of this is better for the bears. But even then, small pullback bull trend, the probability of making money selling is not great. This turned out to be a profitable swing down for the bears. But the probability is it was going to go sideways and not down. We're at resistance and we're not breaking strongly to the upside. So I think we're probably going to go sideways here, maybe for a couple of hours. What do you do here? 20, I would not buy. I would wait for a second entry buy. It's a credible enough reversal and a possible parabolic wedge that the odds are a lot of bulls will hesitate and they'll wait for a second entry buy closer to the moving average. And for the bears, they really wanted 3 bear bars. They have 3 bars that are not bull bars. 17's not a bull bar, but it's not all that bearish. Sellers or buyers above 19, above 20. I think probably sellers above, and I think we'll probably go more sideways to down. But I still think the bull case is better. However, I would get out of longs and wait for a micro double bottom, maybe 1921 or 1922. I'm going to turn the screen off for a second. You can see not a lot of buyers above 20 and probably bear scalpers taking a chance that even if we go to a new high, we probably will not go much higher. If we go to a new high, it probably will become a bigger parabolic wedge top. 1 pullback, 2 pullback, 3. I think we're in a zone where the bulls are not going to be all that eager to buy, at least for a while. I'm going to turn the screen up one more time and check my example file. Bear scalpers made money. Now, will bear swing traders make money? Will this be similar to the reversal from a couple of weeks ago? Probably not, but this is what the bears are hoping, that it's the start of a big reversal down. The rally is not as climactic. Here, lots of small bars with prominent tails and lots of overlap. Here, small pullback bull trend, lots of bars, lots of gaps. So much more extreme buying, and the result was a much more extreme reversal. Here, a less extreme rally, and so there's less sense of the market being exhausted and overdone. I still think it's more likely that we're going to go sideways and get near the moving average. It's possible that this becomes a trading range and that we get all the way down here. But I think the downside is not all that great. You sense much of a strong reversal. Now it looks like we're entering a tight range. We'll probably get fairly close to the moving average. I think it's okay to buy for any reason below bars, above bars, but I think you need to stop at least a couple ticks below 10. And I think we're going to get closer to the moving average before we go very far up. The bears want a small double top, 21, and then a second leg down. Probably, as I talked about earlier, we're going to be in a tight trading range. I got to turn the screen off for a moment and see if I can open that examples file again. So this is the general idea of what I think we'll get. We're a little bit more climactic. This never became climactic, and that allowed it to continue up. Today's a little bit more climactic. And right here. So I think we're probably going to be going sideways here, possibly for 2 or 3 hours, maybe 10:30, 11:30. Can you buy right here? No, this is where you take profits. We're probably in a scalping mode now. Will bears short here? I think they only short if they can use a wide stop and scale in. We still have a gap, 22 low, 7 high. And that's important because that tells you that traders selling above prior highs are not yet making money. I do not think we're going to go all the way up there. But do I think this gap will close today? Probably. Or at least I think we'll get down to the 7 high. I don't know if we'll drop below the 7 high, but I think we'll get there. And I think we'll get to the moving average as well. And this is probably what we're in the process of doing, this or this. What about selling with a stop? Well, the range is so tight, I think it's better to be selling above bars, above 20, above 21, above 17 if we get there. 1 point above 23 maybe. But selling with a stop, sometimes you hear me talk about a tight trading range with a double top, lower high, major trend reversal. This is a tight trading range with a double top, lower high, major trend reversal. Usually you need at least 10 or more bars in the tight trading range. Otherwise, the tight trading range continues. So even though this is a double top and a lower high, it's a double top, lower high, and a minor reversal. The pattern is not big enough. Tight trading range with a double top. That's a higher high. This is a double top. This is exactly a double top. But this is more what I'm talking about. Tight trading range. Here, we're sideways for about 20 bars. We got a tight trading range with a double top. And after you get the breakout and follow through, you need the 2 bear bars to increase the probability of the market going lower. Anyway, this is more like what I'm talking about. A tight trading range, a double top, it's slightly lower high. But this has about 15, 20 bars, and that is enough bars for a major reversal. And when you get it, you usually get 2 legs down, and the second leg is usually bigger than the first. It's not usually this big, but usually the second leg is bigger than the first. So 1 pullback 2, or 1 pullback 2. This is a double top and a tight trading range. Okay, this is one where this is similar to what we have now. Double top and a tight trading range, but the pattern does not have a lot of bars, and the reversal that you get usually does not lead to a big bear trend. It's a minor reversal. In other words, trading range or a pullback in a bull trend. Well, it's interesting. I just looked at, I sold the 21 high, and I just looked at my software, and I noticed that I was filled before it dipped. When I was filled 4 ticks below the 21 high, before it fell 5 ticks. That happens about 10% of the time. Usually 90% of the time it has to fall 5 ticks from my entry price to fill me. Close of the second hour, bar 24, also another good bull bar. So what do you see? You see a pretty tight bear channel, so a big down move, and now we have a gap up with 2 big bull bars, a big up move. Usually the result is a trading range, big confusion. It's down. No, it's up, but it didn't go more than halfway up. It's still, so to me it's a confused market. We're at resistance, the daily moving average, this gap, the top of this sell climax, the bottom of this trading range, which is that low from 2 weeks ago. So to me, there are too many good bullish things and too many good bearish things. So the market is confused, and we're probably going to go sideways for a number of bars. A number of bars on the 60-minute chart, which obviously means a lot of bars on the 5-minute chart. Bottom of the range might be the bottom of this buy climax, which is on the 15-minute chart down there. Probably buyers around the moving average, but probably not a resumption of the bull trend. The bulls will probably wait until 11 o'clock, 11:30 before they try to get trend resumption up. Here, it took until 10 o'clock to start getting higher, and it never got all that much higher. That's the breakout point, and it's around the moving average. Remember I said I thought we would get to within a tick of the 7 high, and we might get all the way down to the 10 low before we get the bounce at the bottom of the range. Right now I think we'll probably stay up around the moving average and 7 high. Well, for the bulls, they have a high 2 buy 23, a bull breakout 24, a pullback 26, 27. So theoretically it's a buy, but we're so close to the moving average. I think the upside is probably not all that great, and I think we'll probably be able to buy near the moving average, within the hour or so. So I'm not eager to buy above 27. You see the energy is all gone. We still might get trend resumption up. This might be trend resumption up here, but we're getting so close to the average price. And when you have a strong rally on the open, the market typically enters a tight trading range until it gets close to the moving average. This is close enough in days where the trend is extremely strong. It never gets especially close to the moving average. But look at the bars after bar 2. That is not a very strong rally. It's a rally, but not all that strong, and probably not strong enough to escape the magnetic pull of the average price. So we probably have to go sideways to down to the average price. Small pullback bull trend, a lot of energy. Did not get to the average price until around 10:30 or so. Sometimes it never gets down to the moving average. Here, it held above the moving average for a long time. touched the moving average, but then barely got near it all day, even though lots of small dojis, never looking all that strong, it went relentlessly up. I think today is not as relentless as that. On my other computer, I just scrolled back over a year. Every day in the past year, no matter how strong any rally was, the market came back to the moving average at some point during the day. And so that's over 200 bars, 250 bars that I looked at, 250 days that I looked at. And I could not find a single one that stayed above the moving average all day. So what do you think? Do you think we're going to go a lot above the moving average and then come down to the moving average later? Or do you think we're going to go mostly sideways and get to the moving average at some point in the next hour or two? That is more likely. The upside from here is probably not very big. What's going to happen at the high of the day? We're going to get another gap. I think bears will sell above the high of the day, either at the high of the day or 1 or 2 points higher, knowing that the odds are high that the gap will close and that we'll get down to the moving average at some point today. That's if we get to the high of the day. We might not. This might be a wedge lower high, 3 pushes 1, 2, 3. So far, the bulls need one more tick for their buy above, they need one more tick for their buy above 27. So bulls will be taking profits here. So the bulls will be selling. Bears will be selling above bars. And bears will be selling above the high of the day. If they sell above the high of the day, they probably have to risk. Let's just see how far up do we go here to here. So the stop for the bears probably would have to be, somewhere a little bit above that, and they have to be willing to scale in. We still have a possible measured move up from this leg, but right now I think we will not get there. Anyway, bears who are selling above 17 probably need to stop above a measured move, betting that if we get above 17, we will not get more above 17 than this rally got above 7. Bull trends tend to become weaker and the breakouts tend to become smaller as the trend goes on. And we also know that the market has like a 99%, but certainly better than a 90% chance of coming back to the moving average at some point today. And therefore, probably will have a hard time getting very far above the 17 high. The reason why I said that the market has not spent an entire day above the moving average in over a year, so that's over 200 bars. So can you look at this and say, well, then this only has a 1 chance in 200 of touching the moving, of staying above the moving average? No, because in those 200 days, past 200, 250 days, there were a lot of bear days and a lot of sideways days. But if you look at the collection of days where the market gaps above the moving average and stays above the moving average for 2 or 3 hours, among those, there's still only a 10% chance that it'll stay above the moving average for the remainder of the day. That's what I'm saying. So at this point, given what we already know about the day, that we've stayed above it for 30 bars, there's still only a 10% chance that it will stay above it for the rest of the day. Because 17 is a credible candidate for high of the day, there's a slightly increased chance that if we get above 17, the bears give up and we get a breakout and a measured move up. But I still think that it's more likely there'll be sellers right around where we are and above 17 scaling in higher, and the market will pull back to the moving average at some point over the next hour or two. Bears made money selling the 21 high. They made money selling the 25 high. They probably will make money selling the 28 high and the 17 high. Wedge with 25, 28 and a bear bar and a lower high. But I think it's a tight enough range so that bears should be looking to sell with limit orders, not stop orders. Bulls, can they buy here? Betting on a failed wedge, a breakout above 32 and measure move up. I'm not doing that. I'm looking to buy around the 22 low and the moving average. And up here, I think it's okay to be selling above bars for scalps, but you probably need a wide stop, like 4 points or 5 points or something. 20 gap bar buy, probably buyers around the moving average. Even if we fall below it, probably bulls will buy the first bear close below the moving average. Even though the bears have a pair of bear bars, traders bought the pullback to the moving average. Strong bear bar, they bought the pullback to the moving average, and they bought the bear close, double bottom. Even this, a huge bear bar, weak follow through. Eventually the bulls stopped the selling and they got some trend resumption back up to the top of the day, the buy the close bulls. Traders might be deciding that we have to get to the moving average now. The bulls might be giving up on a new high. The bears made money selling above 25 and above 28. The bulls did not make money buying above 25 and 30. So the market is becoming more neutral, getting down to the moving average now. So buyers around the moving average, buyers around the 25 low, the 23 low, and around the 13 buy climax low and the 10 low if we get there. Bears trying to get a gap and a measure move down. They have a wedge, 1, 2, 3, and a lower high. Probably not enough selling pressure here for a major reversal, and therefore this is probably a minor reversal, even though it's a wedge lower high. Minor reversal means that a trading range is more likely than a bear trend, even though the bears are trying to get a breakout bar here. The market's simply deciding how far down the bottom of the range is. Double top, you can call it a wedge lower high, and that would be probably the outer limits of what the bears would get, and that's right down at the bottom of the buy climax that started over here. You got 20 gap bar bulls who have been happy to buy above the average price. Now they're finally getting a chance to buy at the average price. So for them, this is buying at a discount. So you'll always get some bulls buying here, scaling in lower. And for the bears, if you're an institution, you can sell here. But as an individual trader, the odds are this is a minor reversal and it's a leg in a trading range. And the bottom of the range might be 23 low. It might be down here as well. This gap 7, I've said several times that I think we'll get down to the 7 high. I don't know that we'll get below it, but I think we'll get to within a tick of it. And therefore, I think we're going lower than where we are right now. For the bears, bear bar 38, bad follow through, bear bar 36, bad follow through 37. And the bears are trying to get another bear bar here. Probably buyers somewhere below 22 and around the 7 high. While it's possible this could become a big bear trend, just like there was a lack of urgency on the way up, so far, lack of urgency on the way down. Bad entry bar 32, bad follow through 36, and so far the bear bars are not especially big. So it looks like we're testing the 7 high, closing the gap. I think we're going to dip at least a tick below the 7 high. We have a buy climax here. So the bottom of the buy climax is a reasonable target. I don't know if we'll fall for a 50% pullback, which is right down there. We also are at the daily moving average. Remember I said because last week was a big week, and here's the weekly chart, and we're in the middle of it, and last week was an outside week, this week might be an inside week. The low of 2 weeks ago, the high of 2 weeks ago, that's that small week from 2 weeks ago. What do the bears need for always been short? They need at least a pair of big bear bars, and the odds are against it. Quiet pullback and then a pair of big bear bars, and that reversed this rally, and it changed the sentiment to always in short. While it's possible this is just a failed breakout 22 low and therefore a double bottom, slightly lower low, I think the 7 high is important enough so that we need to get closer to it. We're within 3 ticks, and while we're still always in long and we have a 20 gap bar buy, and this might be the low for the rest of the day, I still think it's slightly more likely that we're going to go a little bit lower, maybe a second leg down from 36. If you're buying, I would put a stop below 10. I think it's more likely that we're going to get a small second leg sideways to down. "15-minute chart, they have a micro double top, a bear breakout, not big compared to the bull breakout, and this is the follow through bar, closes in 5 seconds, and that is not a good looking follow through bar for the bears. So that is consistent with the 5-minute chart, that the reversal looks more minor, like a leg in a trading range, although I think we're probably going a little bit more down. 20 gap bar buy, but I still think slightly more likely we'll get a lower high, and then we'll go a little bit lower. Bears selling here. Where's their stop? Is it above 32? They could put a stop a couple ticks above 32, but guess what? Other bears are going to sell the 32 high and 17 high of the day, betting that a trading range is more likely than a resumption of the bull trend. Limit order bulls 22 made money. Bears making money selling above things. Bulls making money buying below. The market's deciding, are we going to a new high, and will it trap the limit order bears, or are we going below 38, and will we trap the bulls, the stop order bulls, 39. I think 36 is strong enough to get a little bit more down. Plus, I think we have a magnet at the 7 high, and we got to within 3 ticks, and that's probably not close enough. Bulls trying to get their trend resumption. Even if we do go to a new high, as I said, it's possible we go up for a measured move. But I also think there'll be sellers above 17 and 1 point above, 2 points above. You know, I showed some examples of a day that had a gap up and a trend, and then a trading range and trend resumption up. A couple of the examples I showed had the bull breakout fail, and the trading range ended up as a final flag, and we reversed back down to the trading range later in the day. This is similar to today, gap up, a lot of trading range price action. The bulls got trend resumption, and it failed. Bears selling above prior highs. Even though this breakout is bigger than this one and this one, it still was profitable for the bears. This is what the bulls want. I do not think they'll get that. This is what they might get. A new high, but probably will fail. I don't think we're going to get that big of a reversal. I'm open to anything, but that's not likely. I'm trying to find, but this kind of thing is what I suspect will happen if we do go up to a new high, that there'll be sellers above scaling in higher, and that the breakout will fail and we'll pull back. This obviously took place after 11 o'clock, so more than an hour later in the day than when we are now. Bulls want this to be a test of the sell climax high, the 30 high, and a double top with the 36 high, or with the 32 high. And the bulls want trend resumption up, double bottom, neckline, measured move up. We still have a potential for a measured move up from this gap. We have a double bottom bull flag. There's the double bottom. There's the measured move from the double bottom bull flag. Here's the measured move from the gap. I think we're still always in long, but at the moment, I think I'm becoming less confident that we'll get down to the 7 high. You know, maybe right now 50-50 chance that we'll get there, and we may not get there until after we go up here and then possibly reverse down sharply in the final half hour or so. For the bears, a little double top, neckline, measured move down. The market's deciding whether to go up here or down here. I still think we're going to get down to the 7 high, whether or not we go up to a new high first. Stop order bulls made 1 point above 39. Stop order bears, I don't know about selling below 45. You know, selling with limit orders, you know, I'm fine doing that. Bulls, will they buy the 36 low, 38 low? They'll probably buy a point below, because if we get below 38, then we'll probably get below the 7 high. So, you know, you might be able to buy it for a wedge 22, 38, and who knows down here. but I think if we get below 38, we'll go at least several ticks below to below the 7 high. Sometimes the market just waits until the final hour, sometimes the final 35 minutes, to decide between trend resumption up and trend reversal down. The odds still favor, if we're going to get a breakout, the odds still favor trend resumption up. But if the bears get a pair of bear bars closing below the bottom of the range, the odds will shift to trend reversal down. Here's that all-time high, the reversal. Here we went up, sideways, got trend reversal down. Here we're up, sideways. Still more likely that will go up. This is the 15-minute chart. More likely that will go up because 15-minute chart always in long and sideways above the moving average. The odds favor resumption up. Strong trend sideways, the bears got trend reversal down. Small trend sideways, bulls got trend resumption up. Once you start to get a lot of bars in the range, it becomes basically a 50-50 market. I still think before the end of the day, we'll get to within 1 tick of the 7 high. That's too big of a gap. Bears hoping that this is a lower high major trend reversal. Okay, swing short, but still more likely it'll test below the 7 high, and then the day will end up bouncing and being a trading range. It's okay to be swinging a short, but like all swing shorts early on, the probability is only about 40%. First 18 bars of the day, right here. We have not broken out of that 18 bar range. But at this point, still 90% chance we've seen either the high or low of the day. Low of the day, more likely. So if we're going to get a new extreme, obviously the high is more likely we'll break above 17 than go below 1. We're closer to it, plus we're still always in long. Bulls buying below bars 50, hoping for a double bottom or slightly higher low 36. Because I think the odds favor a test of the 7 high, a reversal here is important. It increases the chances that we will not test down there and that will simply go up here. The range is pretty tight and it's scalping. I would rather be buying with limit orders below bars or buying a reversal up from below 36 or from below the 7 high. And for me, it's too low to sell. The swing bears are short, stop above 46, but if 53 is a bull bar closing near its high, I think most of the bears will get out because it's a high 2 and we're still always in long. For the trend resumption bulls, I think they buy above 53. I still think it's slightly more likely that we're going to go a little bit lower. Bulls trying to get trend resumption. This is an unusual time of the day. It's starting a little bit early. Sometimes it starts at 11, 11:05, or 11:30, 11:35. And this is starting about 10 minutes early, 53. It's still possible we have a double bottom, higher low at support. We're bouncing up. We broke above the low of 2 weeks ago. Tested it again. So if you want to call it a double bottom or a wedge, doesn't matter. Still always in long, but a lot of traders will wait to see if we can reverse up strongly before buying. Traders have been scalping for the past 3 hours. For the bears, another lower high. For the bulls, a breakout, and they see 55 as a pullback from the breakout. A lot of the bulls who bought 53 will scalp, and they have a 5-tick trap so far. They need one more tick, so a lot of them will get out around break even. I think the range, for me, the range is too tight right now to trade, so I'm not doing anything. Although limit order bulls buying below are still making money, and probably the bears who sell above 50 will probably make money as well. Remember I said back here, not enough bars for a double top major trend reversal. This is enough bars. 40%, plus you have a bear body. 40% chance this double top lower high is going to lead to a swing down. So it's okay to be short. You're risking about 6 ticks or so, trying to make 4 or 5, 6 points. You have a 40% chance of success. Higher probability, wait to see if we get a breakout bar and a follow through bar. Small breakout of a small breakout. We have a 1-tick breakout of the 38 low, which is a 1-tick breakout of the 22 low. You can call it a wedge. You can call it a small breakout of a small breakout. If it rallies for 2 or 3 bars and then breaks below 58, there would be a 60% chance that we would get a measured move down. The market's deciding between trend resumption and trend reversal. Trend reversal is a small breakout of a small breakout, which is a type of wedge that's relatively flat. It usually only works if you get a bull breakout of the wedge, which we have 57, 59, and a lower high, and then a reversal down below the bottom of the wedge, 50, 58. Theoretically, this is a stop entry sell below 58 with a reasonably good probability of 2 legs down if it triggers. And for the bulls, they have a wedge bull flag, but not a good buy signal bar. It's breakout mode. The bears have a double top here. So theoretically, a swing buy above the double top, and the bears have a wedge bull flag here, and theoretically a swing down below the wedge bottom. While I usually don't like to enter with stops when the market's in a tight range, this actually has okay math for buying with a stop above 56 or selling with a stop below 58. I probably will wait to see what the breakout looks like. No one knows, first of all, whether or not we're going to get the breakout today. Second, no one knows whether the breakout will be up or down. And no one knows whether the breakout will succeed or reverse. The market's in a very tight range because of the uncertainty. If we do get the bull breakout, I still think it probably will not get very far before it reverses. Very good location for the bears. Here's the 15-minute chart. Here's the all-time high. This is the bottom of the pullback, so it's about a 50% correction. It retraced to the top of the sell climax from the other day. And it's also in the middle of last week. This is the high of last week, the low of last week, and we're right in the middle. And we're also right at the daily moving average. Here's the daily chart, a little bit above the daily moving average, a little bit above the sell climax high. interesting math right here. Selling at the market, 62 high or so, stop above 56. So you're risking 3 ticks, betting on the double top holding and the market instead reversing down below 58. The math is okay. You're risking 3 ticks to bet on a breakout below here and falling down here. So you're risking 3 ticks to make 4 points, maybe 15, 16 ticks. And the probability might be 30% right now. In other words, right now, 70% chance we'll get above 56, maybe 60% chance. So the math is actually very good for the bears. Most traders, I think, are waiting to see what the breakout looks like, and then either trading in the direction of the breakout or trading the reversal, if there is a reversal. Now, chances are the breakout is not going to be all that strong. Look at the bars today. We had 2 strong bars, and the rest of the bars were pretty ordinary. So out of 64 bars today, we've had 2 strong bars. And of the remaining, whatever we have, 19 bars, 17 bars, chances are we're not going to have a lot of strong bars. Chances are they'll be mostly unremarkable. Small breakout of a small breakout. You can see a lot of traders entered on a stop, 58 low, and they're buying back for a scalp. The bulls want the breakout to fail. In general, when you have a breakout like this, where in most breakouts, if there's a stop run, there's a 50-50 chance that you reverse up. And this is a situation where the probability is higher that we'll get better than a second, better than a 50-50 chance we'll get a second leg down. Bulls obviously want 65 to be a strong reversal bar for a failed breakout below the wedge. And bears obviously want 65 to close on its low. But if it does not close on its low, they'll try to prevent the reversal from getting up very far, and they'll try to get a second leg down from 64. In general, when you have a small breakout of a small breakout, there's about a 60% chance of 2 legs down. This is the first leg down. 40% chance the breakout fails and it just reverses up. In general, when you have an obvious stop location like that, it's 50-50 chance that the breakout reverses up. Here, it's slightly lower that it will reverse up, slightly higher that it will go down for at least a scalp. And why is that? I don't know. It's just an observation. You got a relatively flat wedge. This is a small breakout of this. This is a small breakout of that. So I call that a small breakout of a small breakout. And it's just an observation. If the market reverses up like this, fails to get above a prior lower high, and then breaks below the wedge bottom, 58, usually about a 60% chance you're going to fall for a measured move. We have a double top, a neckline here. The measured move probably will be more like that if we get the measured move down. Presumably there's some news, somebody said something, but who knows? We're in breakout mode and we're triggering one of my patterns. I don't think of it as a typical wedge because it's so flat. To buy above 65, I think the bulls would like to have a pretty good bull body, not just a one-tick bull body. If it's a one-tick bull body, a lot of the bulls will wait to see if we get a second or third bull bar. And for the bears, sell the close, they would like 65 to close on its low. Well, what do you think the chances are that it's going to close on its low and become a big bear bar? Well, look at all the bars today. If you ignore the first two bars, how many times today have you seen consecutive big bars up or down? 0, right? So probably something's wrong, going to be wrong with 65. Either it'll have a bull body or a big tail on the bottom, or the bar will be not all that big. The more it closes on its low, the higher the probability is that we'll go down at least a little bit more to the measured move target. Remember I told you up here, the math was actually pretty good for the bears selling above 62. I debated it and I just got lazy and did not take it. But the math, after I looked at it for a while, I said, yeah, it's probably better than a 50-50 chance it's going to pull back a little bit after it goes above 62. And then you can use a tighter stop above 63, and you'd be risking 2 or 3 ticks to make 2 or 3 or 4 points. Okay, so the bears got the minimum that they possibly could get. They got a small bear body, and 2-tick tail. So, enough to generate confusion, enough to make it slightly more bearish than not, but not enough to make traders start selling at the market, saying, "Wow, this is really going down." Right? To me, it's a disappointing follow-through bar. So slightly more bearish than bullish, but I think disappointing. So that reduces the chances that today will be a reversal day and go far down. Increases the chances that it's going to be more confused. All day long I've been saying it should get down to the 7 high, or at least to within a tick of it. We got a little bit below it. So that objective has been met. What's going on here is a lot of the bears who sold late are buying back the shorts because they're disappointed by the sell-off 65. To buy, the bulls probably will want 2 big bull bars or 3 or 4 small bull bars. Suppose 66 closes on its high. Bears might start buying back shorts above 66. Limit order bulls about the 58 low and 1 point lower made money. So that is not good for the bears hoping for the second leg down. At this second, I think it's slightly more likely we get the second leg down. If 66 closes on its high, I think it becomes a little bit less certain. And by second leg down, I'm not expecting a big bear trend. I'm just expecting a, maybe a little bit of sideways to down. I ended up selling late and getting out break even. What happens below 65? Well, the bulls made money below 58. The bears made money selling above everything all the way up here. The bulls probably will make money buying below. They made money below 22, below 38, below 52, and below 58. We can accelerate down. Next target is the moving average, 60-minute moving average, and then the 4 low. Measured move just a little bit below. Part of this is the bulls who bet on the failed breakout giving up. Not a good low one sell, 66. Bulls made money below 58, so Some bulls will buy 66, others 67, others at the measured move target or down here at the 4 low. Does not look like it's going to be a big reversal day. Here's the daily chart. The bears have to do a lot to make this bearish. They have to get, way down here. And right now, the follow through after the sell-off is not enough to make traders believe we're going to get down here. Bulls trying to get a second entry for the failed breakout. Remember, the odds were the bears would get a second leg down. 67 might be the end of that might be the end of that leg down. Some bears sold to close 65, disappointed 66, placed limit orders to get out, break even, 65 close, and part of the hesitation right here is from the bears buying back their shorts around break even. Not good for the bears as a second entry failed breakout. The bears are hoping that the market goes above 68 and forms a low 2 short with a decent bear bar. I think a lot of the bears will get out. If they have not already gotten out, they'll get out above 68. And for the bulls, it's not yet a high probability buy because of the possibility that we still get a low 2. So 66, low 1, and then 69, low 2. But you can tell, the probabilities are just not what traders want. Traders want the breakout to be a high probability sell, and the bulls want the reversal up, the failed breakout to be a high probability buy, and it's not either one. It's consistent with what we've had all day. Nothing is clear, and the probabilities are around 50-50 instead of 60-40. It's still, I think, always in short, but if it goes several ticks above 68, it'll go back to always in long. The math for the bears right here is interesting. They can sell right here above 68, and if the bar becomes maybe a 4-tick bull body, they get out and take a 3-tick loss. It's similar to selling at the 62 high. And for the bulls, it's a second entry buy for the failed breakout. Again, the probability is just not all that good, bulls or bears. Breakout's not all that big, follow through bad. I am currently flat. I think it's back to always in long. If it goes 2 or 3 ticks, on a small day like this, if it goes 2 or 3 ticks above 68, it lowers the probability of the high 2, and it increases the probability of the reversal. Therefore, more likely buyers below 73 than 71 than sellers. The bears want the low 2, but this is too far above what was the bear flag. So this is more of a bull breakout, and probably buyers below 71 for a pullback from that breakout. For the bears, they still want low 1, low 2, but this is high enough up, even though it's not all that high up. It's high enough up, I think, to make this back to always in long and make a reversal more likely than a lower high and a second leg down. I am flat, but if I had to do anything right now, I'd be long or buying 71. Let's say it's a 3-tick bear body closing below the moving average. That would be a best case for the bears, and that would make the probability back to 50-50. Right now, it's less than 50-50 for the bears, more than 50-50. That will go at least a little bit higher. But the range is still very, very small. We're getting lower highs, lower lows, but the range up each leg is only 2 or 3 points. I looked at Bitcoin again today. Up 20%, which is really incredible. This is an ETF that follows Bitcoin, but it's, I think, certainly not tradable for day traders. Here's the 5-minute chart of the ETF. Okay, so the slippage is tremendous. The volume on some of these bars, 125 shares, 109 shares. It's just not tradable for day traders. And I think it's really not all that good for traders trading the daily chart either. Now, bears made money selling the breakout below, and now we're trying to get the breakout above. Can you buy with a stop? I think it's really not a very good stop entry market. Probably bears selling above 56, selling 1 point higher, 2 points higher. End of the day, right now we have a buy the close trend, but not a great location, and also it started early, 12:10, usually does not make it to the end of the day. So rather than going straight up, either it'll reverse or get a pullback and then go up. A lot of traders now believe it's always in long, and they're hoping to buy a pullback. Who's going to sell below 74? Nobody. All right. 5 consecutive bull bars by the close. Probably buyers below 72 or 73. And it's a low probability short without at least a micro double top, which means that the market probably, for the bears, will have to go sideways for at least a few bars. Bears will sell 56 high, or 1 point higher, 2 points higher, high of the day. But really, chances are we're not going to get good trading for the rest of the day. If we're lucky, we'll get a pullback, maybe a 50% pullback in the next couple of bars for a scalp up. The bears want a double top, 46, but 5 bull bars closing on their highs, more likely buyers below. And bulls want a strong breakout above 56, and more likely they'll be disappointed. Then it'll be similar to the bear breakout on the downside. Maybe they'll get a scalp, but probably bears selling at the 56 high and or 1 and 2 points higher. The bears are hoping this is a pullback from this bear breakout. Sometimes you get a bear breakout and you get a pullback that goes above the top of the bear breakout, and then you get a swing down. But with 5 consecutive decent bull bars, the probability is the first reversal down, there'll be buyers. Strong bear breakout and a pullback or a rally to a new high, but I think this is also a pullback from this bear breakout. This is an example of what I'm talking about. Sometimes you get a strong bear breakout and a reversal that goes above the top of the bear breakout, but that reversal, instead of a bull trend, is a pullback from the breakout, even though the pullback went above the start of the breakout, and then you got a second leg down. Probably buyers below 72, maybe at the 72 low, moving average, 50% pullback, or the 66 high. You'll have some bears who sold 66 and then more 1 or 2 points higher, and they wanted to get back there, so you'll have bears buying there. It's also at that key price, the low from 2 weeks ago. It's also the top of that sell climax. Weekly chart. Last week outside down. It was a buy above the week before. It was a sell below the week before, and it's now testing the bottom of this inside bar. It's also testing on the daily chart the top of the sell climax. Looks like the 50% pullback is right around the 66 high. Low of 2 weeks ago. We've been trading around it all day, so we might have to get down to it again. But always in the long, probably buyers either 73 low or 1 point lower. Buyers moving average, buyers 66 high. For the limit order, bears who sold 66 and above. And then probably buyers around the low from 2 weeks ago, the green line. The bears want 3 bear bars, kind of a magic number. If you get a reversal with 3 bear bars, it increases the chances that the reversal will succeed. I still think we're in the buy zone, and it's more likely there'll be buyers here, even though I'm not expecting the market to successfully break out up or down. I think we're probably going to close around the green line because it's been such an important price all day. You know, we kept testing it all day. Bulls trying to prevent 3 consecutive bear bars, so they're buying around the 74 close. You also have the scale and bulls trying to buy 1 point below 73. We got to their limit order, did not fill them. 3 consecutive bear bars increases the chances that we'll fall below 65, but the odds are more likely that we'll stay around the green line. Here's the breakout right at the end of the day. Really not a good stop entry buy. I bought with a limit order and I scalped out. I'm back to flat, so I'm missing this. A lot of times when you get these gap up days like this, that rally on the open, they spend several hours sideways, and a lot of times the rest of the day is sideways. So gap up and rally, and then just nothing. And this is pretty common. Usually rallies for about 10 bars, sometimes 20 bars, and then just stay sideways for the rest of the day. Bar 17 remained the high for the remainder of the day. You can see we're closing right around the key price of the day, which is the low from 2 weeks ago, and it's also the top of the sell climax from Thursday. Here's Thursday's big sell climax. We're right around there, and it's also the low from 2 weeks ago. This is 2 weeks ago, a small range week. We triggered a buy going above its high. We triggered a sell going below its low, and now we're back to the breakout point, the entry price at the low 2 weeks ago. We're also around a 50% retracement of the entire sell-off from the all-time high. Bulls hoping for a breakout above a bear channel, and they're hoping to get a higher low major trend reversal, head and shoulders bottom, left shoulder head, right shoulder, and a resumption up to a new high. And the bears want this to be a 50% pullback or a double top lower high major trend reversal and a break below the neckline. I said that on the daily chart, we had a good breakout on Thursday and bad follow through Friday. I said that if we had a couple dojis, 2 or 3 dojis, the bears would still have the probability favoring them for a second leg down. But if we had a big enough reversal, a strong enough reversal, one 20-point bar like today, or two 10-point bars, it would make the market back to neutral 50-50, which I think it is. But if we get one or two more bull bars, then we're back to this, and the odds will favor higher prices. Right now, I think 50-50 chance this breakout is going to have a second leg down and a swing down here. 50-50 chance the big breakout's going to fail, and we're going to go up to a new high. Weekly chart, last week a big outside down week, and this week probably an inside week. We opened in the middle of last week's range, and last week was an exceptionally big week, and also we had two small weeks here, so chances are small here. And then we have, I think, three major central banks making interest rate decisions or policy decisions in September. The market, therefore, might wait to hear what the central banks are going to do. So we may go sideways for another several weeks. This is a very common thing where you gap up. Here we pull back a little bit, but rally strongly in the open, and then just go sideways, for the rest of the day. That's fairly common. Here, gap up sideways, tried to get a bear breakout, and then got a bull breakout. Here, sideways, got a bull breakout, and then got a bear breakout. First bar of the day, I thought 30% chance low of the day, closing on its high, and then bar two, another good bull bar closing on its high, maybe 40% chance, maybe 50% chance we've seen the low of the day. 4, we got dojis 3 and 4, and for the bears a failed breakout yesterday's high, but a trend from the open bull trend, a breakout above the 60-minute moving average. We have the magnet of the low of 2 weeks ago. Just above, we have the 50% retracement just above, probably buyers below 4. 6, 5, not a good looking high 1, but probably going higher. 8, a second entry sell, failed breakout yesterday's high, but tight channel and target above, so probably buyers below 8 and buyers above 9. And 12, we're trying to get a second entry short, but did not trigger. 13 did not fall below 9. It looks like it did here, but it actually did not. 13 did not fall below 12. It looks like it did, but it did not. And then a breakout 13, 14 at the target, the low of 2 weeks ago, and the top of Thursday's sell climax, but no sign of a top. Looks like by the close. And then 18, a small parabolic wedge, 2 legs up, 7 and 17. It could be the high of the day. I think we'll probably have at least a couple small legs sideways to down, and we may be entering a trading range for 3 or more hours. Well, we entered the range for the rest of the day. 20, a high 1 buy, but big enough down and parabolic wedge, sellers above, but probably tight trading range and probably buyers around the moving average, which we got over here. Then 23, a high 2 of the bull bar. You can buy for a scalp, but it looks like we're in a tight range, and traders sold with limit orders above 21, above 25, and they made money, and bulls bought with limit orders. Not so much 32 low, but moving average, maybe 30 low and 27 low, and they made money. Then we just stayed sideways all through here. 39, a failed breakout and a micro double bottom. Bear breakout 36, micro double bottom. Bull bar, 20 gap bar buy. Okay buy, but it's probably going to be a scalp. And then selling below 46, double top 36, bear bar closing on its low. It's too far down to sell. I think if you're selling with limit orders above 41, above 36. And then 53, another high 2 at the moving average, plus a double bottom 38. I think we're going to get to within a tick of the 7 high, so I would not swing above 53. We're probably, may go a little bit higher, but not much higher. And then we have a double top 56, so double top, lower high, major trend reversal. Market usually tries to get 2 legs down, and here it got 2 very small legs down, 58 and 65. The second leg is usually stronger than the first, but this is a very small version of the pattern. And then the bears had follow through 65, but a tail, and then bad follow through 66, and then 68, a second entry buy for the failed breakout below 58. So it's a small breakout of a small breakout, 58, 38, and 22, but it looks like it's failing. It fails about 40% of the time on average. And then we got by the close rally above 40, or up to 46, and then we just buyers below. I thought we would dip below the 66 high, which we did. It's a trading range day, so you have to assume the market's going to fall below support and go above resistance, and that limit order traders betting on reversals will make money. Buy the close, sell the close, 1 close, 2 close, 2 close for sure, and then 3, 4, 5, 6, 7, all buy the close. Probably again 14, 15, 16. And that was probably it. Maybe 70. We're going a little bit higher there. And then limit orders, the easiest one was the 4 low, probably the 8 low as well. And then once we got that buy climax and the reversal on 19, traders started selling above bars, above 20, and buying below. Sell above 20, above 21, above 25, above 28, and then above everything here, above that, and then above this, and they bought below bars as well, below 30, below 29, below 22, and they bought bear bars around the moving average, like 36, 52, and 64, and we ended up staying sideways, closing around the entry price for the bears, selling the bear IOI reversal last week. Market still is deciding, are we going to get further up? I think we will. Are we then going to go down? I think we will. So right now I still think it's probably slightly more likely that this is a bear rally and that we're going to form a lower high. But one more day like today, or even a modest, 5 or 6 or 7 point bull bar tomorrow will make it more likely that the bear reversal has failed. And that does not mean the bull trend resumes. It just means the bear reversal has failed and will probably go sideways more. Sometimes you get a bear breakout like this and a failed reversal, and then the second leg down comes 2 months later. We had an example of that last year, right here. Okay, rally, trading range, bear breakout, and the market went sideways to up for 2 months, and then got a small second leg down. And I still think 50-50 chance that this is what we're having right now, that we're going to go sideways to up, but not get to a new high, and then we're into a trading range, and the bears will try to get a second leg down. But if we go much higher from where we are now, I will conclude that the bulls have won. Right now, I think it's neutral, maybe slightly more bearish than bullish. And the second leg down might take 2 months before it begins. Okay, in general, is it best to wait for the close of a bar before making a trade? If you're looking, a lot of times, in general, yes, in general, if you're making a trade based upon a decision on the appearance of the current bar, I always wait for the bar to close, or maybe I'll enter a second before it closes, because so often in the final few seconds, the bar changes dramatically. It can be a very good looking bull bar, and then when it closes, it can be a doji or a bear bar. So if you're using that bar and you need its appearance to help you decide whether to enter, I would wait for the bar to close. Question, I need to reduce my risk because my account is small. I've noticed low risk entries in the pre-session trading range. A limit order low or high of the 4 hours before the session could get me in early with lower risk. This happens often. Today was a bull flag. What is your thoughts about preseason entries? Okay, he's saying during the day session, a lot of times the bars are big and the legs are big, so the stops are far. And a lot of times in the Globex session, the legs are smaller and the stops are tighter. And should you consider entering in the Globex market, like buying above here or above here? I personally think trading the Globex is fine. However, the premise that it has a significantly greater number of low risk entries, I think is not probably not correct. As you know, I tend to like wider stops and scaling in, but on a day like this, it's reasonable to buy above 25, a high 2 and a bull trend. It's reasonable to buy above 39. You're not going to go get rich. You're buying for a scalp. It's also reasonable to buy above 68, but a stop below 68. So, it's certainly reasonable to buy at the 4 low and risk even just 4 or 5 ticks, because if it's good, it should not fall more than 3 or 4 ticks. Typically, it just falls 1 or 2 ticks below 4 before going up. So I would not give up on the day session, but I would be more selective and try to find trades where it's reasonable to use a tight stop, which means high 2 bull flags, low 2 bear flags, or wedge bull or bear flags, or reversals up from key support, reversals down from key resistance, especially if you get a second entry or a micro double bottom. Here you can argue 20 gap bar buy, micro double bottom, down, pause, down, and then a bull bar. But that, so I don't have a problem taking the entries in the Globex market because it's so heavily arbitraged and traded by so many institutions around the world that it's a very reliable market to trade. I think, though, that the day session also has decent trades as well. And I'm not sure what your minimum risk is. I think in general, you can probably find a lot of trades where you only have to risk 2 points or 3 points. And I think it's hard to be a successful, profitable trader if you're unable to risk at least 2 or 3 points. And you don't have to risk 5 points or 10 points. If you can risk 5 or 10 points, you have many more trades that you can consider. But if you can only risk 2 or 3 points, there usually are at least 5 or 10 trades a day that you can take where you could risk that. Buy the 2 close, maybe stop 3 points down, buy the 4 low, even buy the 8 low, should not fall more than a few ticks. All right, so to me it looks like big down, big up, big confusion. I still think the odds are this sell-off and the context were good enough so that we're going to get a lower high and we'll test back down here or begin the swing down here, with that bar, even if we go up a little bit more. Weekly chart, still a lot of room to the moving average. 39 bars without touching, extremely unusual. So unlikely to go much higher without getting down there. I think that we're probably going to be mostly sideways for the next year or so, and the market has to decide where the top and bottom of the range are. This is a possible bottom. Down here is a possible bottom as well. And this to me looks like, especially on the daily chart, it looks like a bull channel, and limit order bears are making money, selling above bars, scaling in. So this is probably going to evolve into a trading range. Bottom of the range probably somewhere down here, bottom of the channel. And if it takes a few months to get there, and then a couple months to bounce up, and then test back down, the whole process could take 3 months, 6 months, maybe a year. All right, hope everybody has a good night.